Welcome to Any Answers Answered. As ever, I'm joined by Tim Good. We're going to have a look at two questions that appeared on accountingWEB's Any Answer section over the last month or so. The first one is from the wonderfully named Mrs. Merton, who has a client who is an actor. And this actor has picked up some work in a theatre 200 miles from home and has found a flat there that they're going to stay in for 7 months. They're worried, obviously since the Tim Healy case, that the fact they're taking their husband and baby with them for the 7 months could create a problem where they can't deduct the accommodation cost. Tim, what do you think?
Well, it's an interesting question, and the Healy case, which we've covered on Tax TV several times, certainly could apply here. The issue in the Healy case, as far as the rental of his flat was concerned, was whether there was a significant non-incidental private purpose in renting that particular flat. And what Tim Healy did was rent a 3-bedroom flat, and the tribunal, when they asked him why he rented that particular flat, were told by him, and perhaps it was the vanity of the performing artiste coming out, that he rented that flat because he knew the show, Billy Elliot, was going to be a roaring success, and he wanted to accommodate friends and family coming down from Cheshire to see him in the show. And that meant that there was dual purpose, and therefore none of the expenditure deductible unless you can identify a proportion that was for the business purpose. Now, in this particular case, where the woman in question is renting a flat in similar circumstances, I think that if the flat that she's rented is a 1-bedroom flat suitable for sole occupation, and her husband and child happen also to stay there, that shouldn't deny her the relief. And I would argue that the benefit of her husband and child staying there was incidental and insignificant. And after all, if instead of renting a flat, she was staying in a Premier Inn or travel lodge for the duration of the contract, then she'd be staying in an ordinary room, and ordinary rooms in those hotels would accommodate her husband and child as well.
And so the key point is that it's an incidental cost, or it's an incidental element, to the cost, which is a business element. She's there for the theatre. The fact that somebody else is sharing that room with her is not going to change the price, and therefore shouldn't be.
That's right. The test is the expenditure incurred wholly and exclusively for business? There has to be that primary business purpose, which there clearly is here, and if there's any personal motive, then that can mean that the expenditure falls foul of the duality principle, but the revenue would have to accept that if it's an incidental, insignificant personal benefit, that should be disregarded.
And of course, one of the costs that Tim Healy didn't successfully claim was he went out for dinner every night. As I've explained it up and down the country, this is because a flat is a self-catering piece of accommodation. If in a hotel you would get your meals deducted, but as soon as you've got a flat, you've got the facilities, so you wouldn't claim it, would you?
Exactly right. No, if you're staying in a hotel, then fair enough, you're going to have to incur the cost of meals. But if you're in a flat, cook your own breakfast, lunch and dinner. And why should you and I, the hard-working taxpayer, subsidise somebody else who wants to go out to the Ivy restaurant or the Groucho Club or wherever it is? So no claim, I would have thought, was in order for the subsistence during that duration.
OK, the second question this month is from an Amanda Leslie, who asks about a client who bought a new home, couldn't sell their old house, and decided that they would rent it out. They then rented it for 4 years, and at the end of the 4-year period, it was successfully sold. They finally found a buyer. The question is, obviously PPR is going to be restricted on that sale, but in what way is it restricted over that 4-year period?
OK, it's worth reviewing the main residence relief rules, what you refer to as PPR, Principal Private Residence Relief. And let's imagine, we're not given full detail in the original posting here, but let's imagine that the taxpayer had owned the property for a total of 10 years. We know that for the last 4 years, the property was let, and would assume that for the first 6 years, he occupied it as his main residence. Now, disregarding the letting for a moment, we've got 6 out of 10 years of actual occupation, the final 18 months as an allowable period gives us a total of 7.5 years. So 75%, 3/4 of the gain, is covered by the main residence exemption. But we've then got the other 2.5 years, the first 2.5 of the 4 years of letting, and what we can then do is look up the rules for letting relief. And the rules are that a property that at any time, and it could be after the letting, as opposed to or as well as, in this case, before the letting, a property that has at any time been the taxpayer's only or main residence can qualify for this letting relief. And the letting relief is going to be the lower of the proportion of the gain for the letting period that's not otherwise exempt. So here it would be for the 2.5 years out of 10, that's 25% of the gain. It's the lower of that, or £40,000. If the property, by the way, is owned by a couple, it's 40,000 each. Now, in this case, we're looking at a 10-year period. Let's suppose the total gain was 160,000. Well, 75% of that is covered, as I've already said. The other 25% is 40,000. So the letting relief would there be 40,000, and there'd be no chargeable gain at all. But if the gain was more than 160,000, then let's say it was 200,000, a quarter of that is 50, the letting relief would be restricted to 40, and you'd have a chargeable gain of 10,000. Albeit, if there are no other gains, that's covered by the annual exempt amount, which this year, as last, is 11,100.
One thing I just want to pick up on, an awful lot of people are aware that letting relief is available, but a lot of people were of the opinion that there is this 3-year for any reason rule that we can count as being principal private residence. But of course, that wouldn't be available to cover that 2.5-year period because
you haven't resumed occupation.
Because the person has to move back in. But just to clarify, you don't have to move back in for letting relief.
Correct.
And that's the very important distinction.
Right.
So letting relief, 40,000 potentially, is available as long as you have lived there at some point. The other rules, things like working abroad, working UK, and the 3 years for any reason, they require occupation before and afterward. Hopefully helpful to the various posters and also the people who are following those posts. Do join us again next month. And also remember, you can see Tim and me on Tax TV. Look forward to your questions this month, and hopefully we'll pick out a couple and speak to you soon. Thank you.